All right, here we go. This is what a lot of people do. A lot of people, especially like those without much experience, what they do is they buy something that's hot and they sell it. They think they're going to sell it when it's hotter, right? Because they wake up in the morning, they check their account, and they see that this stock is up 70% in one day, so they want to hop on the train. Or maybe somebody's on, I don't know, somebody's DMing them or somebody's texting them, telling them like, "Hey, bro, check this out." What they do is, so this stock is trading at its 52-week high. So what they're doing is they're buying here, right? Somebody asked me like, "What do you think about this? What do you think about this stock?" I just go look at the chart, right? That's the first thing I do. So imagine this goes up. It went up 40% a day, and they're like, "Oh, it's at its 52-week high. It could keep going higher." And they just signed a contract with so and so, and this is going to be the most valuable precious metal corporation in the history of the world. And they got to deal with Superman. They're going to make kryptonite and all this stuff, right? I'm just going to simply look at the RSI and be like, that's hot, and I'm going to stay away from it. That's it. Like, that's how simple it is, but everyone gets caught in this idea because the media is telling them this is the hottest thing, and their friends are telling them this is the hottest thing, so they're buying when it's hot, and then you know what's going to happen after this. Or I can't tell you what's going to happen, but what's most likely going to happen is it's going to fall. It's trading above the 20. It's trading below above the 200. The RSI is hot. And most likely it's going to fall, right? But people still go buy this because they think that because it moved 40%, it's going to move 70 more percent or 20 more percent, 15 more percent. But they're just hoping that it will. They have no like indication that it's likely to keep going. They're just guessing. They're just taking educated. It's not even an educated guess. It's just they're hoping. And they're putting their hard-earned money behind these, I don't know, super random like dreams that they think that something is hot and this is going to keep going hotter. So, all right, stay away from stuff like this, right? When people ask you about stocks and what stock should you buy or go check this out and go check that out, come right here and put the symbol in, and then look. It's hot. You're gonna buy it when it's hot and think you're gonna sell it when it's hotter. It's gonna fall, bro. And if it doesn't fall, let's say if it just keeps going, then it's your duty as a mature investor to say that move wasn't for me. Even if this eventually goes up to $80 and it doubles from the time that your friend told you about it, it's on you to have a strategy and say, even if your strategy isn't my strategy, your strategy doesn't have to be this strategy, but you have a strategy and you stick to your strategy. And you say like, no, my indicators didn't say for me to buy it, right? So it's great that you got 100% return on top of, whatever, but it wasn't for me, man. I wish I could have caught it. I wish I could have caught it right here. If you can't catch it right here, it's not for you, right? Or I mean, you can even catch it here, but the reality is buying something when it's up here just because everyone's talking about it is not a strategy. That's just hopes and dreams, right? All right, so how to find stocks, track stocks. You could build lists. You can do all types of things. There's many ways for you to do this. So you can build a list on Yahoo Finance. You can build a watch list. So if you want to watch all your favorite companies that you shop with personally, then you go on Yahoo Finance. You can go to the New York Stock Exchange itself. They have a directory, and every single stock that's listed on, there's thousands of them. You can find it there. You can go to Google, and you can build a list on Google as well. So this is Google. So if you Google a stock like Beyond Meat stock, you can then follow this stock. It'll pop up finance, and then you can follow the stock. You can it's creating a watch list. You can do the same thing in Robinhood. You can create a watch list. So, before you start dumping a bunch of money in it for the new people, before you start dumping a bunch of money in, just start watching. And then before you run out and go buy, your favorite companies or your favorite companies, then check the stock or check the chart. Go to stockcharts.com and say, okay, what is it looking like? Is it moving sideways, up or down? Right? Where is it in relation to the 20-day moving average? Where is it in relation to the 200-day moving average? Right? Is it in a downtrend? Is it in an uptrend? Trading sideways? What's going on? Right? Ask yourself these questions before you just click buy. Okay, and then if you are going to buy it, when are you going to sell it? And if it hits your target because you set a target and your target is the 200-day moving average, are you going to sell the whole thing? You're going to sell fourth, a third, half? What you going to do? You know, have all the, write your strategy down. Write your strategy down and then don't violate it, right? You violate it with your emotions because you're making a lot of money or you're losing a lot of money, right? So as long as you don't violate your own rules, I don't violate my rules, so I don't get too frustrated. If I lose money because something took a dip below the 20, I got to get rid of it. I got to get rid of it. You know, I just stick to my strategy. All right. So now we're going to talk about investing for dividends. So when you buy quality companies that pay dividends, you're just buying some income for yourself, right? So you give them money, they make more money with it. They take some of the earnings, they take some of the profit, and then they turn around and give you a reward. And they reward you and say, thanks, bro. You know, like, good looking. So some companies been increasing their dividends for 50 plus years. Coke, Procter & Gamble, 3M, right? Black & Decker, Johnson & Johnson. Like, these are like some of the best companies in the world that pay dividends. They slowly increase their dividends every single year. So people want to buy into these companies, right? Some companies can offer a 15% dividend and they pay it 1 or 2 times. And then they're like, yeah, about that, bro. We're about to move to 3%, 2%. Or we're cutting our dividends in total, you know? So more important. So when you Google, like right here, this is a Google of Coca-Cola, right? It'll pop up on your Robinhood, it'll pop up on your TD Ameritrade, Thinkorswim, Charles Schwab, whatever. The dividend yield will pop up right here. But more important than the dividend yield, you need to go check the recent payouts. You need to go check all the payouts because the dividend yield is a number that represents the dividend that's paid divided by the price of the stock. So if the stock takes a dip, the dividend yield might pop up like extremely high. You know, like dividend yield might say 30% just because the stock took a hit, but you know they're not going to pay 30% of what that stock is divided by 4, which is every quarter, right? Like, you know that they're going to have to cut the dividend, or you know they're going to have to do something because they're not about to pay out 40-30%, right? So don't just look at the dividend yield. You need to go check out their payouts and see, you know, have they been paying out? Have they been paying out consistently? Have they been increasing their dividends? Do they have enough money? Do they generate enough revenue to pay out? Or they have too much debt? If a company has too much debt, they're not making enough money. Usually the first thing to do is their dividend. So these are things that you have to be aware of. So don't just look at the dividend yield, pull out a calculator and start buying, right? Because you aren't going to buy this unless, you know, it's your time to buy it because you looked at the chart. But if you're an investor, you know, it's not about all about chart watching when you're an actual investor. So that was more about trading. This is about investing. So if you're just going to put some money in and then consistently buy, then you don't really have to check the chart all the time. But you do need to go check out their payment history, right, for their dividends. So I'm going to talk to you about that. Right. So for instance, dividendinvestor.com. So you can put in a ticker here. So I'll put in J&J, Johnson & Johnson. So, you know, they make baby powder and all the lotions that you be putting on your baby, so your little baby smells good and stuff. They make all that stuff. They've been around for a very long time. And they've been paying dividends for a very long time. And they've been increasing their dividends for a very long time, right? So here you go. So far, 2020, they're going to pay out this next dividend in June, but you can see 2019 they paid out $3.75 per share. So that's broken down into 4 quarters: 1 payment, 2 payment, 3 payment, 4 payments, right? 2018 they were over here at $3.54. So notice in from 2018 at $3.54, 2019 $3.75, right? 2017 $3.32, 2018 $3.54, 2016 $3.15. So it went up. Here it goes up 17 cents per share. Here it goes up 22 cents per share for the whole year. So you can obviously see they're increasing their dividends, right? So you want to go check the history, you know, and see what's going on. When are they paying? What days do they pay? When do they have their X date? And you're going to learn about this stuff in your goodie bag, the declaration dates. But this is a strategy that you can do. So you can buy this stock, hold it for a long time, build a portfolio around a bunch of dividend paying stocks, and then receive the dividends. And then your dividend will keep going up every year. So here's the beautiful thing. Imagine, let's see if I have, what is Johnson & Johnson trade for right now? I don't know. I think it's about 130, right? So imagine somebody bought Johnson & Johnson years ago when it was $30 a share. Right now it's $130 a share, but I don't know, maybe 15 years ago they bought it for $30 a share. They're still receiving these dividends to this day from that one stock they bought for 30 bucks. So the dividends already paid for themselves and they made a one-time purchase. But you're going to, your strategy can be purchased consistently over a long period of time, All right, moving on. A real estate investment trust. So it's a lot of people are interested in REITs. So what REITs do is they're in the real estate field, and then they generate their income from real estate, and then they dish out 90% of their earnings to their investors. So these are corporations that invest in apartment buildings, they invest in malls, they invest in warehouses, they invest in hospitals, they invest in different things. And then they take the money that's paid from the company that's in the space or the tenants that are in that space, and then they dish it out to their investors. So 90% of all their profits have to be distributed out to their investors. So that's pretty cool. So, I mean, imagine like you can receive the benefit of real estate without actually owning real estate, right? So the cool thing about having a REIT is REITs don't have roof leaks. REITs don't have plumbing problems. REITs don't have, anything like that. REITs don't have tenants that, they could have tenants that don't pay. Let me not. All right. So, but yeah, these are the benefits. You can get exposed to the real estate market just by investing in these trusts. Okay, so here's what qualifies as a REIT. This is from Investopedia.com. So they have to derive 75% of their gross income from rents, interest on mortgage that finance real estate, or real estate sales. Then they take 90% of that and they dish it out to their shareholders in the forms of dividends, right? This is not a one man. It's not like you and your buddy are the only investors. They have to have at least 100 shareholders after its first year. So they have, rules and regulations that they have to follow. So, yeah, let's keep it moving. All right, so different types of REITs. So some REITs are, are data centers. Some are office buildings. Some are apartment buildings. Some are hotels. It could be so many different things. There's different industries that these REITs go set up in, and if you want to pick your specific one that you like or whatever, or you can just start like looking into to diversify your holdings. But yeah, it could be REITs, could be anything. So I'm gonna show you what's cool, because this is like real life stuff. I know it sounds like it's like, for the new investors out there, I know it just sounds like you own a stock and eventually they give you money, right? But it's like deeper than that. You're like in tune with everything that's going on, and I'll show you how, right? Okay, so on the left we have an apartment building, and in that apartment building, think about who lives there. There's a family that lives there. There's maybe a woman that lives there or a man that lives there. Whatever, a bunch of people live there. And then on the right is a shopping center. There's a shopping center actually out here in California. And in the shopping center, there's a Rouse, which is a grocery store. There's a Fitness 19, that's a gym. There's a Chase. There's different stores there in the shopping center. So I want you to think about how this plays out, because maybe somebody watching this lives in an apartment building, or I know for sure people shop at grocery stores, right? So these people over here that live in these apartment buildings, it could be you, it could be me, it could be anybody, but they get up and they go to work every single day so they can pay their rent. And they pay the rent to the corporation that owns this building. And what does the corporation that owns this building do? They turn around and dish out money to their investors, right? So that's like, the flow of money. Same thing on the other side with, excuse me. All right, so same thing on the other side. So these people, the same group of people who might live in these apartments, or even the people that live in the local houses, they turn around and they go to the grocery store. Ralph's has to pay. Ralph's doesn't own this building. Ralph's doesn't own the shopping center. Fitness 19 doesn't own the shopping center. Chase doesn't own the shopping center. They don't own the building. They pay a lease every month. So the corporation that owns the shopping center gets the money paid from the leases and dishes it over to their investors. So this is, these are the type of things that REITs, that you can invest in when you invest in REITs. Okay, so New York Mortgage Trust, that's like one of the popular REITs that I talk about. I started buying into New York Mortgage Trust maybe 5 or 6 years ago. So sometimes I'll fall in love with them and I'll buy them and hold them. Sometimes I'll sell them. So, okay, so they just took a hit. So last October, November, they were trading for about $6. So remember I said everyone took this hit around Corona time. So remember I said not to just look at the dividend yield, because look at this yield, 38%, right? They're going to have to either cut their dividend. They're going to have to do something, right? They're not going to pay out 38%. Or maybe they will, but they can't sustain it. So anyways, so check this out. On January 27th of this year, the beginning of this year, so they announced that they were going to pay out the dividend December 20th. And then on January 27th, in my Robinhood account, I had 1,324 shares. I got paid 20 cents per share. So I ended up getting $264.80. So keep this in mind that it required me to work 0 hours to do nothing. I didn't show up for any meetings. I didn't do anything, right? So, and that's just in my Robinhood account. So in different accounts, I have, I have a bigger balance, but yeah, there you go. So imagine this. If I were buying these shares for $6.10 and I'm getting 20 cents per quarter, which ends up being 80 cents per year, it means every time I give them $6.10 or whatever the current price of the stock is, they're going to give me 80 cents back every single year until something changes, right? So that's like, man, when you go to McDonald's and you spend $6 on a meal, you get full for 3 hours and you get fat. But if you give them $6, they give you 80 cents back, and the $6 is still yours. You just, it's just tied up in an investment. So REITs are a really good thing, but obviously the stock price can go up and go down. So the value of your account can go up and go down. Like if you're still holding a New York Mortgage Trust now, if you're buying at $6 and it's worth $2.08 now, you're taking a hit, but eventually it'll come back up. So they can cut their dividends. It's nothing set in stone, but it's a really good way to start building a portfolio that pays you. So you can wake up in the morning to having some money, Okay, so there's a website that's pretty cool. It's called REIT.com. You can filter by the sector. So you can say mortgage REITs, industrial, healthcare, diversified data centers, whatever. You can put whatever in there or click whatever sector you want, and then they'll have all the REITs that they track. If you're in Robinhood, so a lot of people watching this are going to be using Robinhood. If you're in Robinhood, you can literally just search REIT, and then this little category icon will pop up. You can click that, and then you can hit follow. So once you click this, then all these REITs here, and so there's 366 in Robinhood. So you can start following, you just start watching them, you can start buying them, you can do whatever. But yeah, so here's a cool website and a Robinhood watch list. So you can go in there and see what they got going on and watch some of the REITs that you will eventually invest in. Okay, municipal bonds. So this is like really cool. A lot of people don't know about muni bonds. So to make this very simple, the difference between a stock and a bond is a stock is ownership in a company, And a bond is you lending money to somebody, right? So you just get a piece of paper saying, hey, you agree to pay me X amount of money. So you're just, that's, somebody's way of raising money is they can issue out bonds. But for stock, they can raise money by issue out stocks, but then you take ownership in the company versus just giving them a loan, right? So the bond investor, you and I, are going to lend money to, it could be the federal government, it could be the local government, it could be the state, it could be whoever, right? And they take that money and then they they're going to pay you interest. So with a stock, you get paid a dividend, but when you loan somebody money, you get paid interest. The same exact way when you buy a car, you have a car loan, you have to pay interest on your car loan. So when you lend somebody money, they have to pay you interest as well. So with bonds, they make interest payments to you instead of dividend payments. And the cool thing about this is if you loan money to the federal government, they don't charge you tax, right? So the income that you get, which is the interest payments, are tax-free, right? And if you loan money if you live in the same state that the muni bond is in, it could be state tax-free as well. So there's bonds that were issued in your state that will be federal tax-free from the federal side and tax-free from the state side as well. So now, if you were to compare receiving a 5% dividend on a REIT or a stock versus a 5% dividend or interest payment, on a bond that's tax-free, then once you filter in the taxes, then the bond might be or will be the better investment at that rate. And then bonds tend not to fluctuate as much as stocks. So so this is really cool. This is a great way for you to start receiving tax-free money. So whenever you buy a stock and it goes up in price and you sell it, you got to pay a capital gain tax on that sale, right? If you receive dividends, that's a form of income. But if you receive interest payments from a muni bond, the federal tax is going to be tax-free, and then the state tax is either going to be very, 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 very small or non-existent, right? So you give the government money so they can develop projects. So it might be, like it says, roads, railways, railway, school, hospital, airports. They could be roads. It could be toll roads, right? So, and I'll show you how they back these bonds, how they make sure you get your money. Okay, so this is from the investor.gov, the government investment website, right? You are lending money to the bond issuer in exchange for a promise of regular interest payments, usually semi-annual, and the return of the original investment is due at like a maturity date, right? So generally, the interest from municipal bonds is exempt from federal taxes. This is the cool thing, right? The interest may also be exempt from state and local taxes if you reside in the state where the bond is issued. I'm not making this up, man, right? So a lot of people don't know about municipal bonds, but there's a lot of big money that dumps their money here, right? Big money. Institutional investors dump their money here. It's one of the top ways you can start lowering your tax bill, right? So there's two ways that the two most common bonds, muni bonds, are general obligation bonds, right? So with a general obligation bond, the state or the federal government can use taxpayers' money to pay you back. And then with a revenue bond is they're usually selling something, or they're charging somebody some type of fee, and then they'll take that fee and pass it over to their investors. So for instance, like the Easy Tax, so this is here in Houston, or not here, but this is out in Houston, Texas. So every time that you're paying to drive on this private road, investors are going to get money, right? And you could be one of those investors who are receiving the money from everybody driving through the private road. So yeah, great vehicle. All right, so Here's a Municipal High Interest Trust. I like these guys. So this is on Robinhood. Their symbol is MHI, but it'll tell you down here, like, it's a closed-end investment fund. Its objective is to seek a high level of current income exempt from regular federal income tax, right? So this is the income that they bring in or that they pay out to you. So check this out. So if they're making a 5 cent, it's just above 5 cents for the payment, and they're paying this every single month, right? Notice these payments are coming every single month. So it adds up to be a little bit above 57 cents, right? And then that gives you a yield of 5.25%. And we know that that's not going to have federal income tax on it. So you might get hit with the state tax from those payments, but you might not. Some of those are state exempt from the state as well. So yeah, just comparing the two, you might want to put some bonds and some muni bonds in your portfolio, and then you might want to just have some REITs or some dividend paying stocks. But this is, more for the investors who want to buy and hold things for a very long time, and then still receive some dividends or still receive some income off of their investments. When you buy a muni bond, you don't need to check charts. When you buy a muni bond, you just buy it. Whether it's $200 a month, $100 a month, $100 a week, whatever, $100 a year, you just put it in there, man. You don't really have to check you don't got to check charts. You don't got to check moving averages, right? So remember, I said there's two different investment strategies, and there's a difference between traders and investors. So for the people who don't want to watch charts, for the people who don't want to worry about risk, you can play it safe with bonds, and especially muni bonds. All right, index funds. So the best way to describe an index fund is, instead of investing in individual stocks, you can invest into a whole bucket of stocks that, the goal is for them to match an index, right? So the S&P 500, they'll try to match the S&P 500 or whatever the index is. There's different indexes for different sectors too. So like if you wanted, index funds for the energy sector or for, the tech sector or whatever, right? So imagine this. So imagine, instead of trying to pick every single, the biggest companies in America to invest in, you can just invest into a fund that invests into those companies. So now you have exposure to the growth of all the companies, right? So it gives you some diversification. A lot of this is a lot of money, big money, just put into index funds, man. You don't have to go out and try to be a stock picker, There's a lot of great information that's going to be in your goodie bag about index funds, right? So you're just buying into the basket. You're buying into the buckets. So if there was a US 10 index fund that holds the 10 biggest US stocks, then this is what the fund will look like. This is what the fund will hold, right? It'll hold Microsoft, some Apple, some Amazon, some Google, right? It'll hold those 10 companies, and then you just invest into the one index fund, and then you can just buy it. These are type of things that you just buy systematically, and then you would dollar cost average. So it doesn't really matter what the price is today or next week. You're just going to buy consistently. Maybe you buy, the first of every month. Maybe you buy with every paycheck. Maybe you buy whatever. So if it goes high, then cool. If it goes low, you're just buying more shares down at the bottom, right? So eventually the cost of your the cost of your actual cost per share is going to be low. All right, so why are index funds so popular? Because they offer immediate diversification, right? So, yeah, you don't have to be the greatest stock picker in the world. You actually don't even have to pick any stocks. You can just pick an index fund, right? You can just pick an index fund that matches the S&P 500, VOO. You can just SPY. You could just pick an index fund and call it a day. You don't need to be, you don't need to be, out trying to pick stocks every day if you don't want to, right? Or maybe you'll have half of your portfolios in stocks, 25 are in index funds, 25% in bonds, and the other ones you want to pick individual companies that you believe in because you want maximum exposure to their growth, right? So, and then also about municipal bonds, about index funds as well, is most people who manage funds, like actively, a manager of funds, like active managers, they can't beat the S&P 500 in a long enough scale, right? So if you did, Warren Buffett did a 10-year bet with these fund managers that they couldn't top the S&P over a 10-year period. He put $1 million up. Of course he won. But it's very hard to, you can beat, because what the S&P 500 is this is the best companies in America. So you might be able to outperform them for a year or two or three. Some people can do it consistently, but over a long enough period, this just seems and continuously proves to be the safest place or the safest way to store your money. All right, moving on. All right, so this is what dollar cost averaging is, right? So you're going to buy shares consistently, right? So you can have, let's say you have $6,000 to invest. You can invest it all at once, or you can invest regularly every 6 months. So then on the right-hand side over here, it shows you the difference. So if you were to invest all $600 or $6,000 that you had on the first day, because you just got $6,000, then you're going to get 600 shares at $10 a piece. But if you buy periodically, then eventually you'll end up getting 678 shares at $8.85 a piece. It's because when the shares dip, when the price of the shares dip, you're buying low and it brings the average cost down, dollar cost averaging, right? Makes sense? It ain't rocket science, right? So when your long-term holds go down in price, then you just buy more, and buy more, and buy more. So you accumulate more shares. So if your favorite long-term stocks take a dip because of coronavirus or threats of a war or a food shortage or, I don't know, Elvis Presley showed back up, whatever causes it to go down, you just buy more, right? You just keep buying more. So then eventually when it goes back up, the cost per share is going to be lower. Okay, so this is how you actually buy a stock. So this is TD Ameritrade. I'm just going to go to the top and I'm going to put target symbol TGT. And then this is what's going to pop up, buy or sell, right? So it's going to have all this information that's, all this information, it was, most of this information was on Google, if you remember. The market cap, I think PE is on Google, earnings per share, I don't think that's on Google. But the open, the day range is on Google, the 52-week range is on Google, but these brokerage services will just give you more detailed information, right? So I click buy, and then this little thing pops up at the bottom. It looks drastically different on every single brokerage site or app, but it's all the same thing, right? They're all going to the New York Stock Exchange to grab the stocks. So the action is going to be buy. So there's a bid price, there's an ask price, there's a last price. This is how many shares are being traded. And then this is what you want to do. Do you want to buy it or do you want to sell it? You want to buy it. Okay, how many shares do you want to buy? Do you want to buy stocks or do you want to buy options? Your order limit or your order type. Do you want to buy a market, which means it's going to execute right away? Do you want to buy a limit, which is telling you're telling the market this is how much you're willing to spend. So if I do a limit buy right here, so how this is set up is buying, I didn't put any shares in there, but let's say I'm going to buy 10 shares of Target or 1 share of Target, a limit buy for $108.50. That means if the price of the stock if they can't execute at $1 or $108.50, I'm not going to own the stock. So if the stock never dips that far, so be it. I'm not going to get it. That's the maximum amount I'm willing to pay, right? And if I were selling the stock, it'd be the opposite. The limit amount would be the minimum amount I'm willing to sell my stock for, right? So talk about this over here. Okay. All right. So the bid price is the highest amount a buyer is willing to pay for a given security. Ask price is the lowest amount the seller is willing to let a security go for. So the sellers are saying, this is what I'm asking for my stock. The bid price is, this is the buyer saying, this is the most I'm willing to pay. The last price is the last price they traded for. Okay. All right, so order type. Market order is an order to buy or sell immediately. It guarantees the order will be executed, but it does not guarantee the execution price. So the market order is you're paying the market price. Whatever it gets filled at, it gets filled out. It's they try to get you near the current bid price. So if you were to do a market order, you can probably expect to pay around here. But there you go. If you do a limit order, I just explained what that is. And we'll move on to the next one. Okay. So market is if you want to sell this immediately or you want to buy this immediately. So where this makes sense is if you're trying to buy a stock, you're swing trading a stock and the stock just moved past its 20. Actually, today was its second day above the 20 and it's trading for $101 and the target is $180. So you have $79 that you expect this stock to grow. Like there's no need for you to sit around and like try to get a limit order so you can buy at 101.02. You know, like those 2 pennies don't matter. Those 10 pennies won't matter. You know, you probably just want to get it executed so you can let it run. Or sometimes it might be the opposite where you're selling and you're willing, like your stock is falling and you're only willing to let it go for X amount, or maybe it's growing, you want to let it go for X amount, right? So a stop order or a stop loss is an order to buy or sell a stock once the price of stock reaches a specified price, known as the stop price. When stop price is reached, a stop order becomes the market order, right? So if your stock is going up and then you put a stop order on down here, then stock is going up this way. And then you put a stop order right here and this price falls, then boom, it'll execute, okay? So you can lock in your profits that way, or you can make sure that you don't lose any money. If you want to gamble on a stock, right, you buy here and it still has a little room to go down. You just put your stop loss in, make sure that your stock doesn't just tank $100 overnight, right? Or it doesn't just keep falling. So there you are. Okay, so here's the Dow Jones. The Dow Jones just measures, 30 companies, 30 large companies on the stock exchange, like very large companies, right? And it's just an index, and it shows you the performance of these companies, of the top companies. So I want you to be aware of something, especially you new investors out there. So this is the 20-year view on this side, and this is since 1915, right? So the 20-year view, which starts 2001, you'll notice it goes, the war starts, so that explains that dip, and then the housing market crashes, so that explains that dip, but then we start to recover. We start to recover and we start to recover, and little dips here and there, and then this is the coronavirus dip, right? But look at the history of since 1915. It might go up and down, up and down, up and down, but overall it's going up, right? So if you compare, this is the Great Recession in the 20s, but that was heavy. But overall, this is why when you're investing long term, you just buy and hold. Because even if your accounts go down, you can just buy more at the bottom, but eventually they're going to come back up. That's having faith in the entire American economy, right? So my uncle tells you about this. I'll show you guys what he's talking about. But, right, it might go up and down, up and down, up and down, but overall it's going up. a lot of times investors, individual investors don't realize these ups and downs or don't realize these total gains because they buy here and they sell here, right? Like they're doing the exact opposite of what they're supposed to do. So think about this. If you were in the market in 2008, right? Let's say you got 100K in the market in 2008, and then it dips, right? 2008, 2009, it just starts falling. What do people do? They panic, right? So they panic. But had they not panicked, slowly but surely, they would have seen the value of their account go back down. Or if they would have been buying more at the bottom or buying on the way down because they're investing consistently, then they wouldn't have needed to get to this point to break even. They would have broke even down here because the average cost of each of their shares would have been lower because they were dollar cost averaging. Makes sense, right? So since 1915, over 100 years ago, that's how it goes. It goes down and up, down and up, down and up, but it goes up, right? This is the S&P 500 for the last 90 years, right? So instead of it being 30 companies, it's 500 companies. It goes up and down, up and down, up and down, up and down, but overall it's going up. And this is why if you're a long-term investor, it's not important for you to check your account every day. It's not important for you to watch the news every day. You buy quality companies that you like, you believe in long-term, or you buy into funds that you like, you believe in long-term, and that's it. You don't need to watch the market every day, right? If you're a trader, get your ass on, watch some charts, bro. But yeah, so every time that this market takes a dip, you have an opportunity to buy America on discount. So it's so crazy that when people's favorite shoes are on discount, they take their ass to the mall. But when people's favorite companies are on discount, they panic, right? So this was an opportunity for people to buy here. Boom. Here was another opportunity. These are opportunities. These are called opportunities, right? You're being greedy when other people are being fearful. So when everyone's panicking because look at this little coronavirus dip, it might keep going down, who knows? But if it doesn't, if it just keeps running up this way, everyone who is buying here, who had the courage to buy here, is going to see their portfolio grow like crazy. So that's it. Thanks for watching. Those are my gems. So you guys make sure the key takeaways are knowing when you're buying, knowing when you're selling. If you're going to gamble, keep your positions small, and dollar cost average if you're an investor. Check the payout histories, and then go through your entire goodie bag. So I'm going to give you a goodie bag, a PDF with a lot of resources, right? Don't expect to become a master investor because you paid, a couple bucks for this course. I'm not a master investor. Nobody's a master investor. If anybody was a master investor, they'd be wealthy, right? They'd be, when I say wealthy, I mean extremely, extremely, extremely wealthy, right? If anybody knew what to invest in, exactly what to invest in, they'd be extremely wealthy. So you come up with systems that give you a slight advantage over the market. So the stock market investing is a long-term strategy. You're not an expert because you watch this. I'm not an expert because I made this, right? So you're going to continue learning from different people. You're going to continue learning from different resources. New companies pop up, old companies fall out of the sky, and you're just going to keep adjusting your strategies, being consistent, and keep learning, right? So remain a student. That's the most important thing, is remain a student. So I'm a student for life. I hope you are too. Stay in touch with me on social media, my Twitter account. Boom, there it is, my Instagram account. If you have any questions, email me, and then make sure you go through the resources I'm going to give you, because they're probably going to be from people who are way better investors than I am, or way smarter than I am. But yeah, we're going to remain students. All right. Y'all take care. Be easy. Stay up.